He is, a lot of you, if you have met Ben through NoteSchool, he's been with NoteSchool for a long time, and he is building his own little bank, a deal or two or 10 at a time. Right, Ben? How you doing?
That's it. Doing great. Happy to be here. Happy to talk about this.
Yeah, this is an amazing thing. Ben's going to jump on here, and he's going to tell his story as we go through this. Kind of how, well, going to tell us how he started Hammelmyer and the relevance of what that looks like. So Ben, why don't we get to it? I'm going to bring up the slides here, and right. I'm going to let you and I are just going to have a little conversation, right?
All right.
You know, Ben, it's kind of like Elvis says, right? A little less conversation and a lot more action, right?
That's right. Yeah.
All right, let me get there.
That song was played many a time in my household growing up.
So Ben, tell us a little bit about, your vision when with Hammelmyer, and what prompted you to jump into that, right?
Sure. Well, I will tell you the original inception, what Hammelmyer looked like before it really became what it looks like today, was different, similar but different. And the original intent behind it was just to kind of say, I went into the doctor, as you know, a family doctor who I've known for years, and they had said, what are you into? And just kind of started talking about the business, talking about what's going on. And I found that he was heavy into, had a big rental portfolio. And he was one of many doctors that were in the same building. And I just happened to talk to him about that day. He was saying about notes that day, and he was saying how he wanted to kind of use his retirement money. And he was about 8 years away from retiring. And he's like, man, I just, all the different things that you hear, stock market and, burnout landlords and all that stuff was there. And I forget how I worded it. And for the life of me, I've tried to remember, but it was something to the effect of, he said, well, Ben, what is it that you really do? And I said, well, Doc, I work with people like you who want cash flow without the headaches, or something, again, very similar to that. And that's what hooked him. And he was like, well, what do you mean by that? And so during that conversation, I found, rentals. He was heavy into it, as with most of the investors that I've spoken with, and rehabs, the traditional things that you hear. Yeah. And I was like, well, what is it? Why are you involved with that? Why was that part of the portfolio? And that's really what started setting up and engaging the conversation. And one of the earliest things I can remember is saying how, it's kind of funny. You and I have spoken before, Joe. And, people are a lot more alike than what they realize.
Right.
And it was funny because you take all different backgrounds, all different types of people, they all kind of wanted the same thing, as we all do, I'm sure. And that's just kind of what set everything up. And since then, we've had 3 iteration or reiterations, kind of what I call updates would be a more accurate description. Just based off of, where we were and kind of how we morphed. Without sounding like it just grew faster than what I thought it was going to be. And that's really what happened. And so what started off was supposed to be very small, just a small group of us of about 4 or 5. And then they started talking to their friends. And before you know it, it blew up into what kind of the phase that we're into nowadays. So that's kind of a background and a very 3.5 years actually 4.5 years into a couple minutes.
But Ben, it started with a conversation, right?
That's
it started with the conversation, and there has never been a better time to catch up with people that you haven't talked to in a year in person, right? Than right now. And it's just that, hey, how you doing? What have you been up to them? And then what are they going to say to you? So what have you been up to, right? Mm-hmm. And that opens the door many times. So Ben, this business model, you had some major requirements that this business model was not going to be another job. You're very busy with your boys in baseball and your daughter in drama, and
Yeah.
and all of that. So you work with NoteSchool as well. And so let's just talk about this, for a second here about what you wanted your model to look like, right?
Sure. And to that point, Joe, that's exactly a big reason of why it looks like what it like. I did not have the time, quite frankly. For those of you who may not know, but I have 3 kids, 2 of which are year-round competitive travel baseball. Mm-hmm. And so we're on a field. That's a part-time job in and of itself. And we're on a field somewhere about 10 to 12 hours a week, not including the weekend tournaments between coaches. I mean, so they're still relatively young, 13 and 10 now. And so that I remembered the whole point of getting involved into investing was to, spend more time with them, not take that time away. So
not less, but more. And this is what it looked like, right?
That's exactly what it looks like. So kind of what you're seeing there, that was my requirements, and it kind of being semi-sarcastic, but in the way it's presented. But this is it. I told them, listen, if we're going to do this, we're only going to be open for business up to 10 hours a month. And that's a month. It's not a typo. And so I went the route. It's funny. I'm going to touch on the rejecting 80 to 90% of the potential clientele. So the reason why I did that was kind of a let's see what happens moment. And as I read a lot, Joe, and I read something where it was something where the scarcity, it's like here's a scarcity model. And if you make it where, people don't want, then something, whatever it was. Right. Well, at the time I said, you know what I'm going to do? I wanted it to be, the intent behind it was to be very selective with who I was working with.
You want to do business with people you like and respect.
Yeah. And I had, we're going back to 2005, 2006, where I had a very brief stint in what I would call wholesaling in the traditional model that people would know it as.
Right.
And I remember back, man, it was just, you're wheeling and dealing, and it was just the work behind it. And that's what I did not want it to become. And then there were some people where you work with, and sometimes, I'm sure we've all had it where it just wasn't worth the money dealing with, either the fallout or dealing with whatever it may be. It was just, it just wasn't worth it. So I started that in the back of my head and in my mind. I was like, I'm going to see what a scarcity model would look like in this. And so I made it to where I was after a very specific person. And what that specific person was someone who didn't know it all, that wasn't going to argue with me, that just wasn't going to create a lot of tension, just someone with a good head on their shoulders, that was open to the idea of seeing what I could do for them. Right.
That's right.
And I found, and it was really interesting, where the conversations, just to kind of finish real quick, limited to 2 to 3 hours for customer service. Because again, I said, and most of that was, hey, listen, if you don't mind, we're going to be on a ball field, so I can kind of do it. And what's interesting is nobody really cared. They didn't really, it wasn't a pushback of any sort. No, everybody was very understanding. The issue that we had was, I'm open when they're at work, and in the afternoon when they can talk, I'm busy. So there was that dichotomy. So the fix that we came up with that was, listen, if you don't mind noise in the background, I can talk. I can, they just want me there to see them anyway. They meaning the boys. And had a zero marketing budget because it was all word of mouth. And 3.5 years, we turned 3 years in November 17th last year, and I have not spent a dime on marketing, and still continue. We just don't need it, but it's based off of that 80 to 90% rejection rate. Which is funny, because I said, listen, we're after a very specific type of person, and I found that the more I held to my guns, and I was like, I'm not willing to bend on that, the more
exclusive it became, and the more they wanted in.
Yeah, it was very like they were like, no, I really want to do this. I really want to, and I was like, well, you're going to have to fall in line. And kind of tongue in cheek here, but They did, man. And it just kind of grew from there. And then I found that they were saying, well, one person said they may have 100,000, right? No, well, I have 150. And this other person, I have 250. I said, it's not the amount. I'm after the person. And there was one point where a guy came in and tried to kind of, be Mr. Big Dog. And he's like, I have $3 million that I could throw. And when I rejected him, the rest of them were like, that's a explosion that happened in my brain. I was like, you know what? That's what I'm doing. I'm after the people, after the person. That's who I want. Right. And because they were all in the same building, it became very easy. And that particular, they kind of weeded themselves out. They're like, no, man, you're not up to par, or you're not. So they started doing all my screening for me. So it was great. Yeah. So that's kind of the beginnings of it.
Right. So then this is you in the middle here, right? You're this deal architect, and you have source of notes through Notes Direct and through some marketing and some other entities or other companies that you can buy through. And your passive investors, they were burnt out landlords. They were stock market refugees or money market refugees and mutual fund refugees. They just happen to be dentists, right?
Yeah.
And so you just melded those two together, right? So, yep. And that's what it looked like.
Yep. Yeah. I never had to take ownership. In fact, I was very particular about explaining to them that the money that they sent, it never came to me. Like it goes to a third party, it goes there. And that was very intriguing. They loved that. It made it where it was a little bit more expedient in the sense of they were like, wait, you're not taking my money? And I was like, no, it's never, it goes directly to the source, and that's what you're doing. And they were very comfortable with that. Started jumping on board.
So Ben, what you did is what Justin Bogart was on last week. Yeah. Justin did it one deal at a time. You put a group of investors together so you could do 5, 10, 20 deals at a time, right? And that's right. Kind of what it looked like, right? So, and we need to move through these pretty quickly. So, but this is what they were investing in, right?
That's it. Yeah. Typical real estate sources, stock market, some type of thing where Ginny and Treasury and ETF. And it's funny. One of the biggest kickers was that Vanguard high yield bonds. I asked the question, well, what is it minus the fees? What's the truth? And you would have thought I asked some unreal, well, what do you mean minus fees? I'm like, well, there's fees involved. And then that opened the floodgates, man. That one thing right there. But that was their go-to. They were, I'm kind of, again, teasing a little bit, but Vanguard high yield bonds at 5.84% at that time, they were it. And they said, man, you can't beat this. I was like, yes, we can actually. So
that's great. Yeah. And that's what it's after the fees, right? It's the net.
So, it drops down significantly.
Yeah. So they were looking, and let's just talk about this real quick. So you did, the process, what are they investing in? And then what did they want, Ben? Right.
Yeah. They wanted what all of us want, cash flow. They don't want to do anything. They want to spend little money, get the highest return. It's the Christmas wish list is what I call it.
Right.
And it's what everybody wants. You want as little money in as most money back without having to do anything, right? The easy button. Remember that commercial? That's the what
easy button. Yeah, but I used to have one of those. I think I still do somewhere around here.
I have one somewhere around here. I think it's in a drawer somewhere, but yeah, it's great. But it was really the point of that was really to get them over that new factor. What I mean by that is most people aren't aware of how close notes are with traditional real estate. It's right. Very, very close. It's not some new, completely distant thing. It's very close. And so I wanted something that kind of showed a commonality. That was like, listen, you have rentals? Oh, so why'd you get that? Oh, it was because of the cash flow. Well, here's how notes kind of do the same thing. And so one of the very first deals that we did, he had, the criteria was that he wanted $3,000 to $4,000 of income coming in a month, up to $500,000 to spend. And he didn't want to do anything like most of them want to. And so I knew that based off of the historical aspect, it was going to build a relationship. And so the first deal, I wanted to meet his criteria and exceed, again, because the zero marketing budget kind of came in. I was like, I don't want to have to dump a whole lot of money into something with a whole lot of uncertainty of what we're going to really do with it, right? Because Hammelmyer wasn't in the picture yet, but this is what kind of set the stage for it. And so I just went out there and knowing the figures, because I had done a few deals, and just kind of been involved with it, I knew I could hit those numbers that he wanted. And what you're seeing on screen is those first, we did a deal where we had 5 performing and 2 non-performing. And those are the pictures of the houses that were there. Bread and butter America, right there in the middle. Those are the numbers there. When you run it, we were the payment there on the second end column. That's what they were receiving a month. Yeah. The investor price is what they paid for it. The broker fee is what I made. Essentially, when it was all said and done, he had up to $500,000, but he only had to spend 341. I rounded. It was 349 and change. And I made about 20 grand out of it. And the payments, I mean, it was almost dead center. It's $34.50 a month once you take away the 2 non-performing loans. And so here's the kicker. The kicker of it is that, those are the numbers. 340, 905 total invested, 34.54 a month coming in. And I made 20 grand and change. And the 2 non-performing, he had a rehab business. Right. And he was like, man, so I introduced him to that, and he ended up only having to spend about $250 in the whole grand scheme of things. So
Ben, this number right here, right? Yep. This is one transaction, right? So you had upfront money, right? You had $20,000 in upfront money.
Yep.
And so your investor was happy because you put this together, right?
Yeah.
And then talk about, this is just some things here. Let's get to the, you had a 10% management fee and then 10% of the profits, right?
That's right.
And here, and let's get through that, and I love that. Remember this. What I'm trying to get to, Ben, is
how we structure it.
I didn't get to the things there, but you can kind of tell us that. I guess we kind of lost something there. But anyway, so tell us exactly then. So this is a typical transaction. You've got money now, and then you've got money later, right?
That's correct. Yep. And so this is kind of where it really went faster than what I thought it was going to do. But basically what they do now is, so that there's the idea behind what Hammelmyer is that there's a 10% management fee up front. And the reason why I asked for that was because they have rentals. And so I just asked for 10% of the management. But I knew that I could beat the numbers that they were, without sounding like it sounds, I knew I could beat those numbers. And so I was like, well, listen, if you don't mind paying 10% to help keep me going with it and to keep rolling, then just give me 10% of the profits on the back end. And they agreed unanimously. I mean, there wasn't even a question about it. There's about 8 of them at the time. And we started going through it, and that's what we did. So we end up, whatever they spend on a note, just for numbers wise, if they were to spend $100,000 on a note, technically they're writing a check for 10 grand to an operational account. So it's 110 total, but there's 2 checks, 100 grand and then 10 grand, which is 10% to me in an operational account. And then whatever money that makes, say that 100 grand we had $1,000 profit, I get $100. But if that 100,000 turned into $1 million, I get 100 grand. So it's whatever the profit comes in. The way we have it structured, at the beginning we had it where it was monthly, but the CPA had he was like, man, can you give me it? Because just because they pay on the 1st, they may pay on the 4th, and so I was like, well, just pay it quarterly. It's what's the difference between 3 months or 1 month? And so as it stands right now, every quarter you get a little payment today, and then whatever that money generates later downfield, we get 10% of that too.
So Ben, what you're saying here is, so up front you made $20,000, which was now money, and on this particular transaction, you would say, okay, it's generating. You get 10% of that income, right? So 34.54 times 12 is 41,448. You get 10% of that on a yearly basis. So people will go, well, that's 41.48. But if we did, this every month, then that's stacking on top, on top, on top. So you have this money, and then you have this money. And if you did that 10 times a year, like the federal government said, $1 billion here, $1 billion there. Now I think it's $1 trillion. That comes into a little bit of money. So Ben, let's just kind of wrap it up and just kind of talk about you know, your I mean, that's a beautiful model, right?
It works for me.
Yeah. And it works for your guys, right? I mean, they're just, you know, we always think of, you know, like a group of dentists or what. Well, they've got it all going on. They're just like everybody else, right?
Oh, yeah.
Just looking for a great, safe investment. And this is what it ends up being.
Yeah.
So Brian, why don't you come back on and let's wrap this up, and then we'll go to the after party after we do this, and more questions for Ben. We can spend some time doing that. So
yeah, absolutely. And I think what's really important for a lot of people to take away is that Ben is basically using his specialized knowledge, what he knows, to be able to provide a service and not just generate a full-time income doing it on a part-time basis, but also keeping cash flow coming in and then these kind of bonus checks for the future. And so he's kind of double dipping or even triple dipping, all because of the knowledge piece, right? You can be the guy that goes out and does, or you can be the guy that knows what to do. And you got, what'd you say, $4.8 trillion. That's a pool of money to essentially raise capital from.
A lot of money, a lot of burnout landlord capital there. And it's just getting bigger and bigger. And Ben, you know, kind of as a closing thing with this, I mean, and this is just one group that just continually does this, and you can do as many of these different groups as you want to do, right? It's just not limited to this one. This one is very profitable, but it's a duplicatable process. Brian, why don't we do this? Why don't you take us to Feeding Frenzy Friday?
Let's do it.